Cryptocurrency is a volatile investment. It can be an attractive investment for risk takers because it offers the opportunity to become rich quickly. However, it's important to make investing decisions based on facts rather than feelings. Investors must recognize their own risk tolerance and establish particular investment goals and methods. In addition, they must be aware of psychological preconceptions that may influence their investments. Herding behavior. Cryptocurrencies are a new form of virtual money that facilitates global peer-to-peer transactions without the involvement of third parties or a central authority. This makes them popular among investors because of their ease of use, decentralization, and security. However, recent research has shown that herding behavior is widespread in the cryptocurrency market and can significantly impact the performance of cryptocurrencies. This herding behavior can be caused by a variety of factors, including investor sentiment, market fluctuations, and regulatory uncertainty. This herding behavior can also cause price bubbles and crashes. Many scholars have studied herding behavior in the stock market, but less is known about herding in the cryptocurrency market. This study attempts to examine herding behavior in the cryptocurrency market, using data from a number of different coins and analyzing the effects of various macroeconomic factors. In addition, the researchers examined how the herding tendency of cryptocurrency investors varies with market volatility. Their results indicate that herding behavior is more prevalent during periods of high volatility, suggesting that fear and panic may be a driving force in this market. The authors also found that the herding tendency of cryptocurrency investors is not influenced by changes in inflation or interest rates, which suggests that this herding phenomenon is a result of investor sentiment. The authors of this study estimate the herding effect in the cryptocurrency market using a rolling windows model and a multivariate regression. They find that herding is more prominent in high volatility periods, and that the influence of media coverage on herding is greater during these periods. This result is consistent with the hypothesis that herding behavior in the cryptocurrency market is driven by inexperienced investors who are guided by social media sentiment transmission. Overconfidence. The cryptocurrency market is a volatile place where investors are subject to many emotional influences. These can range from euphoria to fear and jealousy. These emotions affect how investors perceive risk and make decisions in the market. It is important for investors to recognize their own risk tolerance and avoid following trends in the crypto market, as it can lead to disastrous consequences. In addition, investors must also be mindful of the influence that social media has on investment decisions. It can amplify positive or negative news and create echo chambers, which can affect investor psychology and lead to herding behavior. One of the most common factors that can cause herding behavior is overconfidence. It can lead to irrational exuberance, where investors believe that prices will continue rising and that they are inherently superior to other investors. This overconfidence can lead to the creation of bubbles that will eventually collapse. This can have devastating effects on the overall economy. Several psychological factors can contribute to overconfidence, including heuristics and biases. Heuristics are unconscious cognitive frameworks that people use to simplify and speed up their daily decision-making process, while biases are errors in thinking that can deviate from rationality or objectivity. Investors who are overconfident may also be prone to hindsight bias, where they overestimate their ability to predict market movements. Mitigating this risk involves examining past investment decisions and analyzing how they worked out, as well as using a pre-mortem strategy wherein investors imagine potential outcomes from a future perspective. The study found that financial overconfidence, agreeableness, and conscientiousness mediated the link between consumer gender and crypto investment intentions. However, the results did not reveal that other personality traits, such as neuroticism, extroversion, and openness to experience, mediated this relationship. Greed. Greed is an emotion that can lead people to engage in unsavory activities, such as bribery and insider trading. In the cryptocurrency space, greed can lead to high prices and market bubbles, which can have negative effects on investors. It can also cause investors to lose track of their own investment objectives and focus on short-term gains. This can be a problem for new investors who may have difficulty controlling their emotions and avoiding greed-based actions. Cryptocurrency markets are speculative and volatile, and their values are largely determined by investor sentiments. A small piece of bad news can send a currency to a nosedive, and one piece of good news can pump the price up to all-time highs. Investors' reactions to these events often follow familiar patterns, which can create a vicious cycle that can result in massive losses. Understanding how fear, uncertainty, and greed affect the crypto market is crucial for those looking to invest in cryptocurrencies. Fortunately, there are a number of strategies that can help you avoid falling victim to these emotions and make smarter decisions. A popular indicator is the Fear and Greed Index, which aims to determine whether assets are trading above their purported value due to greed or below them because of fear. It uses a range of data, including Google Trends, to evaluate the current state of the market. For example, a spike in Bitcoin searches could indicate that the market is overheating and that it is time to sell. However, it is important to keep in mind that the index is a lagging indicator and may not always reflect current investor sentiment accurately. It can also be influenced by other factors such as regulatory action. Cognitive biases. Cryptocurrency trading can be a thrilling and exciting experience, but it's also full of risks and uncertainties. Understanding the psychological factors that influence decision-making is important for avoiding common mistakes in this volatile market. One such psychological bias is overconfidence. It can lead to a sense of infallibility, leading investors to overtrade and suffer substantial losses. Another cognitive bias is the sunk cost fallacy, which can cause investors to hold on to depreciating investments in the hopes that they will recover. Moreover, people tend to overgeneralize information when making decisions. This is a result of noisy deviations in the memory-based information processes that convert objective evidence into subjective estimates. Examples of this phenomenon include illusory correlations, overestimating the impact of one's actions, and believing that everyone else thinks like they do. The good news is that these cognitive biases can be corrected with mindfulness and the use of heuristics. A study by Ellen Katrina Nyhus, Darius Oral Frank, Michael Krzysztof-Kroll and Tobias Otterbring found that gender and personality are important determinants of attitudes toward investment in crypto. They also analyzed the links between herd mentality, overconfidence, and other biases. This research sheds light on the factors that drive herd behavior in crypto markets and offers a starting point for understanding cryptocurrency price formation. The findings also suggest that herding in crypto markets may be due to a price coordination mechanism. However, this hypothesis needs further testing. Fear of missing out. Cryptocurrencies are gaining popularity and investors want to get in on the action. However, this investment vehicle can be a volatile one. Investing in cryptocurrencies requires careful research and understanding the risks. Moreover, it is crucial to know your own risk tolerance and set clear investment goals before investing in any coin. By doing so, you can avoid FOMO-driven behavior and make wiser decisions. Another psychological factor that can influence cryptocurrency investing is herding behavior. Herding behavior is a phenomenon that occurs when people follow the crowd without conducting their own analysis. Herding can lead to irrational exuberance, which leads prices to skyrocket and then collapse. It can also lead to panic selling, which pushes prices below fundamental value. The best way to prevent herding is to study the market yourself and learn about the various coins. The psychology of crypto investing is complex. In addition to herding and overconfidence, there are other factors that affect investor decision-making, such as cognitive biases. These include the illusion of sunk costs and confirmation bias, which can cause investors to remain committed to their investments even when they're experiencing losses. These mental traps can lead to huge losses if not heeded. A recent study in Norway found that a person's motivation to invest in cryptocurrencies is influenced by their personality traits and their level of financial overconfidence. The researchers used a survey to gather data from 126 Norwegian adults about their intentions and current status regarding crypto investments. The results showed that individuals with lower levels of agreeableness and conscientiousness were more likely to be open to investment in cryptocurrencies, while those with higher levels of these traits were less so.